Welcome to the deep dive. Our mission today, well, it's to cut straight through the noise of last week's financial markets. We're focusing on the week of October 6th through the 10th, 2025. We want to give you the essential truth, really, about where the big institutional money was flowing. And we're doing this by diving into a structured vault asset, the proprietary insights from the LoopMarket Weekly summary. Now, we should acknowledge this analysis was authored by Devin McClarty. It's owned by D Investment Enterprise LLC and published by D Publishing Group. We're leveraging their system to track those big money footprints. Okay, so let's unpack this. The market last week, the overall tone was described as broadly constructive. That sounds a bit, well, polite. It suggests buying, but it wasn't like everything was rising together, was it? It sounds more like targeted moves.
Precisely. Yeah, broadly constructive barely covers it. What's fascinating is how decisive the advance was. It was really driven by this clear shift where, growth and momentum stocks, they were rewarded handsomely, pulled capital right in, while on the other hand, the traditional defensive stocks really lagged behind. And you saw that clearly in the NASDAQ and S&P 500 climbing steadily. It signals institutions were making very specific high conviction bets, not just passive buying.
Okay, so you mentioned specific bets. The source points to tech and financials as the main engines here, driving those index gains. But how did the system itself, the proprietary analysis, actually confirm this move towards risk?
Right, that's where these systems' core metric really shines, the EV percent spread. And since we rely on it, it's probably worth clarifying what that actually measures for you. Think of it like the market's own internal risk gauge based on their proprietary model.
Yeah.
It's designed specifically to track the differential flow, basically the speed and the sheer volume of money moving between those high volatility growth names and the safer traditional defensive sectors. So when that spread widens towards growth, it's telling you institutional risk appetite is high. They're willing to bet. And last week, well, the gauge finished with a very clear bullish bias. That's the system saying pretty definitively that the confidence to take on risk was exceptionally strong.
Okay, so the system's basically waving a big risk-on flag, investors chasing growth, not safety. What did that actually look like on the ground then? Where did institutions actually put their money?
Well, we saw two main destinations really stand out. Let's start with technology. The analysis called it out for its, quote, continued dominance. And the big story wasn't just, small gains. It felt like a confirmation of a longer-term trend playing out.
Right, and HPE comes up immediately. The source says it achieved a confirmed breakout above $40. Why is that number, $40? And that specific term, confirmed breakout, why is that so important?
Yeah, confirmed breakout is crucial. It signifies a real definitive shift in how institutions see the stock. Getting past $40 and doing it with strong inflows and momentum backing it up, that's not just noise. It suggests the market now believes the company's fundamentally shifted gears somehow. And if you connect the dots, this breakout is likely tied to underlying optimism about future spending cycles. Think cloud infrastructure, AI build-outs areas where HPE is a major player. Investors are basically betting those spending cycles aren't slowing down. They're robust.
And it wasn't just the giants like HPE, right? The source also mentioned Xenix. It entered the system and quickly aligned with that same tech strength. So it suggests the rally isn't just riding on the coattails of the existing big winner.
Exactly. That's a great point. The fact that a newer name, Xenix, can come in and immediately get institutional backing, aligning with those bullish flows, that proves the sector's health runs deep. It shows there's depth there. New money is actually flowing in and finding attractive spots beyond just the usual suspects. It reinforces that whole momentum idea.
Okay, let's shift gears a bit to financials then. The story there seemed more like recovery, maybe, than outright leadership. WU, Western Union, for instance. It had a modest rebound, improved its positioning in the system from a lag zone to a match zone. Can you decode that jargon for us?
Sure. So lag zone basically means institutional money was actively underweighting it, or even pulling capital out, a real lack of conviction, Moving up to a match zone signifies a shift. Institutions are now positioning it more in line with the broader market. They've stopped selling, maybe stabilizing their holdings. It suggests renewed interest, moving away from that deep skepticism towards maybe neutral or slightly positive.
And the analysis gave a very specific reason for that shift, pointing to WU holding above a key level, $12.65, and attributing that strength specifically to fintech inflows.
Yes, and that detail is vital. It tells you it wasn't just a broad rotation into, say, all banks. It was targeted money recognizing value or perhaps stability in specific parts of the financial world, in WU's case, that intersection of traditional finance and technology. Fintech. Holding that $12.65 support confirms that buyers, likely institutions, stepped in quite aggressively right there. It signals that maybe the worst of the doubts about WU's valuation are passing.
Okay, so this is where the market really draws that dividing line, isn't it? While tech and parts of financials were sprinting ahead, the defensive sectors were actively getting sold off. They just kept lagging behind. This whole rotation towards growth areas. That's the other side of the broadly constructive coin.
It really is. This is textbook risk-on capital rotation. Classic stuff. When confidence surges, those safe haven assets just become less attractive compared to the potential returns you might get from growth names. Investors are actively cutting exposure to things they think won't give them those outsized gains if the economy's picking up steam. They're effectively saying, look, I don't need the insurance policy right now, I need performance.
And the performance numbers for some defensives were, well, pretty brutal. HSY, Hershey, a classic defensive name, it saw further declines, actually hitting 52-week lows. And the reason cited was margin pressure.
Yeah, and that specific detail, the margin pressure, gives crucial context. HSY isn't just suffering from, lack of interest. There's fundamental pressure. Hitting 52-week lows because of margin worries connects the stock market action directly to bigger economic realities, things like persistent inflation, maybe consumers being more sensitive to price. Perhaps the price of their chocolate bars isn't keeping up with the rising cost of cocoa or labor. That erodes profits, and investors react by dumping the stock.
Meanwhile, another defensive name mentioned, RCI, just kind of drifted sideways. Minimal liquidity. The contrast is just stark, isn't it? You have HPE breaking out with momentum, while HSY breaks down to year-long lows. Really defines the mood.
It absolutely does. That's the story of the week, really. High conviction, high confidence in growth areas, and active disillusionment with names that seem to be struggling against those inflationary headwinds.
But, okay, there's always a nuance, right? This aggressive rotation wasn't completely uniform. That brings us to healthcare. USPH didn't grab the headlines, but the analysis noted it provided, quote, quiet consistency, maintained stable, slow, steady accumulation all week.
Right, and that stability, while maybe boring compared to HPE, is actually deeply significant. And raises an interesting question. If big money is fleeing traditional defenses like HSY, why is USPH seeing this steady, stable buying?
Well, it's likely because healthcare often operates on different drivers, more structural, long-term things like demographics, aging populations, the essential nature of health services. These things are often more insulated from the kind of cyclical sentiment swings hitting consumer staples like HSY.
Ah, okay. So institutions are being selective even within their safer bets. They aren't ditching all stability. They're holding on to positions maybe tied to those long-term structural needs while actively selling the cyclical defensives that are more vulnerable to things like margin compression right now. Exactly. That's a perfect way to put it. It shows the market isn't acting irrationally, just very selectively. They're prioritizing growth, clearly, HPE, CNEEX. They're stabilizing positions in cyclical recoveries where they see value, W. They're maintaining core structural holdings, USPH, and at the same time, they're punishing sectors showing real operational weakness in the current environment, HSY. That stability in USPH kind of ensures there's still an underlying floor of demand, even when momentum is the main game.
That's a really powerful synthesis. It suggests, like you said, the market is being quite discerning. The front lines were sprinting, but the foundations didn't just crumble. Okay, so let's look ahead then. What does all this data from last week suggest for the coming week? That's October 13th through the 17th. Given the strength we've just discussed, the proprietary system's overall bias is set at moderately bullish breakout continuation mode.
Yeah, and that phrase, breakout continuation mode, that's key. It tells you the system's expectation is for these dominant trends we've seen especially, that push into growth to likely persist. It's not signaling, an imminent reversal or a sharp turn back towards safety. The momentum seems to have legs, according to the system. So for you listening, if you're focused on specific areas, the outlook gives some pretty clear pointers. With HPE, the focus remains on that breakout. The analysis suggests watching for a potential upside extension, maybe testing that $40 to a $41 range. Clearing that would signal even deeper institutional buy-in at these new levels.
And what about that financial sector recovery we saw with WU?
For WU, the expectation is probably more consolidation. It's likely to stabilize around its current support levels after that initial rebound, kind of digesting those fintech inflows before figuring out its next move. But unfortunately for the laggards, HSY and RCI, well, the outlook suggests continued weakness there. Unless there's some major macro shock, some event that forces money back into defensive postures, the path of least resistance seems lower for them right now.
Okay, so boiling it down, the momentum theme looks set to continue. The market's signal, confirmed by that EV% spread metric, is that the growth story is still the main story, and that rotation we saw last week is probably going to carry over into this next week. So if you're aligned with this proprietary data, the implication is to maintain exposure to those high conviction names.
Absolutely. The week was really defined by that powerful and, as we discussed, quite discerning capital rotation. It really demonstrates the value of a system like the one from D-Investment Enterprise LLC in trying to identify where the real flow and conviction lie beneath the surface noise.
And the main takeaway for you, our listener, seems crystal clear. The market is currently, maybe even ruthlessly, favoring momentum and confidence. It's driving specific stocks like HVE to confirm new highs, while at the same time, it's pressuring those cyclical defensive sectors like HSY that are visibly grappling with margin issues and lower liquidity.
Exactly. And that brings us to a final provocative thought for you to mull over as you watch the markets this coming week. If this proprietary system keeps flashing breakout continuation mode, indicating that strong risk appetite persists, what would it actually take to break that? Specifically, what kind of unexpected news, economic data, geopolitical event, something significant will be powerful enough to finally pull names like HSY and RCI out of their deep weakness and put the brakes on this growth rally? Because reversing this trend now would likely require a pretty fundamental shift in overall market sentiment, something to definitely track.
A great question to keep in mind. That's our deep dive for today. Until next time, happy tracking.